Let's shift our focus to, the financials space, right? This is a very specific focus on the personal loan segment that we're going to sort of talk about here. During CNBC-TV18's Banking Transformation Summit earlier this week, Jairam Sridharan, Managing Director of Piramal Capital and Housing Finance, said that we are just months away from the next credit cycle. He was, to be sure, referring to the unsecured portion, not the entire sort of banking system or loans made everywhere, but to the unsecured segment, personal loans. Ramesh Iyer, Vice Chairman and Managing Director at Mahindra Finance, kind of countered that and almost said, well, that perhaps is not what he's seeing in his business. And Mahindra Finance, of course, is largely rural, but, I mean, it's not unsecured. Their business is largely secured. I want to play both those sound bites out for you, and then we'll invite guests to talk about this.
I think we've all got to imagine that whether we can see it coming or not, a credit cycle is coming, right? And now, which part of the segment it might come from?
How many years out, you think? I mean, best guess.
You use the wrong word there. I would say months. You look at the data. What do we see right now at the industry level? We see secured lending products, risk continuing to come down across the full industry level. You see personal loans products, risk was coming down for a long time and now it has stabilized. And you see credit cards, it was coming down, it stabilized and now it has started going up. So credit cards has gone up. Within personal loans, which look stable, if you split it up into small ticket and large ticket personal loans, small ticket personal loans risk has already gone up compared to 6 months ago. So credit cards and small ticket personal loans risk is already up. MFI just went through a cycle 2 years ago, so they're not going to see any problems for a little while. But the semi-urban, urban markets, unsecured lending, is risk going to be remain where it is today, 6 months from now? I would bet serious money against it.
We've always believed that in this cycle, you have to be very sure and clear about circumstantial and intentional defaulters, right? If you've chased, you've kind of chased growth and you've lent to people, and you believe that, their ability to repay itself is doubtful, of course, they will all have this problem whenever such cycles hit. And if you look at the book, most of the people book, what is NPA today are actually circumstantial NPA, because if it is an intentional default, we've already taken action against it. Either we have taken back the asset and settled it, or we have provided for it and be done with it. And also look at this cycles, how the whole mechanism works. 90% of the people in this country borrow and they are responsible to repay. You don't even need to follow. It's the 5% who require some nudging, some follow-up, some reminder they pay. The whole struggle is for the last 5%.
Okay, let's welcome in the guests then. Saswata Guha is Senior Director, Banks at Fitch Ratings, and AM Karthik, Vice President and Group Head, Financial Sector Ratings at ICRA, is now joining in. Gentlemen, great to have both of you here. Appreciate it. Saswata, let me start with you. You heard Jairam very clearly outline that it's not years away, it's months away, not especially, but the unsecured credit segment. Do you, first of all, agree with that? You've put out some numbers recently. You've been talking about this. So tell us, what is your assessment?
Yeah, morning, Prashant, and thanks for having me. Yeah, we have been talking about it because as a rating agency, we try and look for potential risks in the system. And as we all know, while the banking system, since I primarily look at banks, has been sort of de-risking for a fair number of years, particularly when it comes to, non-retail. But I think on the retail side is where the risks have been built up. Of course, a large part of that has been driven by secured retail. But as we know, in the last couple of years, 2 to 3 years, I would say, is when unsecured retail has started building up. And I think that pace that has picked up momentum quite significantly in the last year or so, especially with interest rates and going up and to a certain extent, margins questionably coming under pressure because of its impact on funding costs. And now, if you look at, the scenario on balance, at a system level, personal loans is roughly about 8 to 9% of the system. For the banks we look at, which are primarily the large banks, I think most are within, say about 1.5 to 2% of their loan book. Of course, there are those where the numbers are significantly higher than that, in the range of 8 to 9%. private banks. I think one private bank is there. There's one, the largest state-owned bank also has numbers similar to that. But the question here is that two. One, of course, is that the credit demand for personal loans in itself has increased. So there is always that risk of over leveraging, one, and two, the pace at which the portfolio has grown, even though from a lower base, sort of would signify a large degree of unseasoned risk. And the second challenge with unsecured loans is on the visibility around end user funds. So, in India, personal loans has always been in demand for, families looking to fund, say, life events or basically economic events. But the limited visibility around the end use sort of makes it very difficult to distill whether the funds that have been given in recent years have been used, one, for economic activity or conspicuous consumption or even speculative market activity. And I think that is the challenge there.
So, Saswata, you're saying, I completely sort of take your point and well explained. So, 8 to 9% of system loans are, you'd say, personal loans. For banks, that would be between 2 and 3% generally. There would be variations, but overall it would be between 2 and 3%, right?
Yeah, for the large state-owned banks, that's roughly where it is at the moment, say barring State Bank of India, which is probably higher. But yeah, the portfolio itself has grown. I mean, on an average, it has doubled. But then there are banks where the portfolio has grown by nearly 4 to 5 times in the last 2 to 3 years.
And to that, got that statement which Jairam of Piramal made, we are months away. So I want a yes or no from you. Do you agree with that?
Well, see, it's very difficult to conjecture on the timelines, but like any portfolio, I would agree that we are probably going to see a cycle in this space sooner than later.
Okay. AM Karthik is also sitting by very patiently, Vice President and Co-Group Head Financial Sector Ratings at ICRA. Karthik, thanks for joining in. I want to talk a little bit about the point that even Saswat was making about the growth in personal loans, right? If you just look at the data, in June of this year, personal loans grew almost 21%, supported by good growth in housing and vehicle loans. What is the data suggesting to you in terms of what the future could look like? Is this something that is sustainable, and what are the trends?
Yeah, good morning. Thanks for having me. I agree to the points that Shashwat made broadly, but there are other mitigants which do support this growth. One, you do have a very strong digital stack which supports data, which is fueling essentially the credit decisions. Otherwise, there is a good amount of seasoned borrowers that we have on board, both for NBFCs and banks, where there is a good amount of leeway to extend personal credit. These are unsecured in nature. And most of these loans are typically priced in a way that they factor in the extent of the possible losses. What we see in typically the non-bank space is that, while the headline numbers that we see from the entities getting reported would be much lower than what we typically see for other asset segments. But the write-offs that these loans witnessed is substantially higher. So we expect, or historically the data is that the losses that we see in this segment is about 2 to 4x of what we see in the overall segment otherwise. And on a steady state basis, we expect these losses to be 4 to 6% on a cohort basis. When I say cohort, it's essentially a loan of 100 is disbursed, there is a possible loss of about 4 to 6% of that loan. Entities are aware of these risks, and the growth that we are seeing of 20% plus is supported by the facts that I mentioned: digitalization, cross-sell, upsell, so on.
Karthik,
but the pricing of the loans is where the play is, and we expect the credit cost to be higher. We expect the growth also to remain high, because that's where there is a diversification and that's where there is a possibility for growth to come in.
So the high cost that these come along, right? I mean, very high interest rates. That should act as a buffer for any loss, and that's, you're saying that entities are well aware, so it's kind of balanced. So you don't agree we're running into any kind of problem in the next few months, as Jairam there sort of pointed out?
So, I mean, the timelines are again always debatable. Any sharp credit up cycle, one would expect something to happen towards the end of it, but it's very difficult to estimate whether when the down cycle starts or even starts showing. Of course, we look at some early warning signals, right? So there are some early warning signals which are cropping up at this point in time, where we try and see if the loan cycle, wherein whatever I mean by loan cycle is essentially that the disbursements are growing at a much higher pace, and the loan rundown is happening slowly, and the disbursement is much higher than the AUM growth, is something that one watch out for.
Got it. Karthik, do you have the figure for what is the exposure at a system level across the board for NBFCs, unsecured segment?
So overall, NBFCs, the unsecured segment, which will include the MFIs, is estimated to be about 5 lakh crores. This is on the base of about 40 lakh crore of the NBFC overall loan book. Within this 5 lakh crore, 1.5 lakh crore is towards the microfinance loans. And the remaining 3.5 lakh crore, we would split it as 2.5 lakh crore towards personal and consumption loan, and about 1 lakh crore towards the unsecured SME loans. This is a position.
So we should take about 3.5, right? 3.5 lakh crores. So yes. Around 5%.
3.5 on 40. So 40 lakh crores. So that's about 9%.
Okay. On 40 lakh crores. Okay, got it. Got that. So, you began, Karthik, by saying that because there is, more digital footprints, data and all, it helps in reaching the customer faster, but does it allow in helping making credit decisions better? That is the question which we will only find out, right, sometime down the line. But certainly there are more digital data points out there on the basis on which these lenders, NBFCs, rely on, not just the CIBIL score. Saswata, any additional points you want to make, off of what Karthik said or otherwise?
No, I think I do appreciate and do sort of agree with the broad points I think Karthik had made. But I like to sort of pick up on the last point of yours, Prashant, which is, to what extent, this sort of digital engine will actually, go in terms of mitigating risk. And the answer is we don't know. I think what we do know is that generally, if you look at credit institutions or banks for that matter, they've had a bit of a checkered past. And a lot of these enhancements, so to speak, have been made in the last maybe 3 to 4 years, which is sort of now helping these banks build that book. So we'll have to wait and see whether some of these sort of digital data stack, whatever you might call it, is essentially going to actually help mitigate risk through the cycle. The only other thing I also wanted to raise here is that there is also an indirect exposure that banks have through the NBFC route. So while if you look at
NBFCs
the average,
borrow from borrow from banks basically.
Bank exposure to NBFCs, because that percentage has gone up a fair bit since 2018, and more so through the pandemic. But even though, say, banks individually, their ticket size may be significantly higher than the odd 50,000 crore that has been that keeps getting flagged as very high risk. But the thing is that we don't know, to what extent banks are having exposure to those NBFCs who are actually giving out those small ticket loans where those risks are significantly higher. So, if there is a cycle, do we feel that it will necessarily destabilize the bank balance sheet? The answer is probably no. But I think it will certainly affect the sentiment that we're seeing at the moment. So, and I think that's also one of the reasons, perhaps, why we have seen the regulator also making a lot of commentary on this well in advance, of the cycle, because there are clearly risks that perhaps even they are seeing, that probably they want to avoid manifesting.
Okay, got it. Absolutely. The RBI has come in and said some stuff. I think Bajaj Finance made some comments in that regard. Chola has made some comments. So we'll see how things go. But thanks very much for joining us here on this program, Saswata and Karthik. Appreciate it. You guys joining in. Well, the